Business Connections Live, the UK's leading online business channel. This is Business Connections Live with Steve Hyland.
Well, a very good afternoon to you. It is Steve Hyland with you here. This is Business Connections Live. We are programme number 85. We've got a cracking show lined up for you today as well, for that matter. My guest on today's show is Andrew Weaver from lawyer comparison site LawyerFair.co.uk. Andrew's been on the program before, and don't worry, we're not actually talking about the same topic that we talked about last time. What's been interesting about the journey that Andrew has been through recently is that he's taken LawyerFair, which is a site for when people are looking for legal advice and all things legal that they can go to. He's going to be sharing his experience today, the pitfalls and perils of funding when it comes to funding, raising the funds that you need for your business. Lots of businesses, perhaps they actually look and they think to themselves, you know what, the aspirations that we have are to fund this organisation, fund our business and make it a bigger, better success. You may find that you've been inputting a lot of funds, your own personal money, into your business to get it to where it was. But this is the next step on, making it bigger, better, more professional, but getting it out there really. But what are the pitfalls? What are you going to come across? As I said, my guest today, Andrew Weaver from lawyer comparison site LawyerFair.co.uk, sharing his experience of the pitfalls and perils of fundraising process. Lovely to have you with us today.
Thanks for the invite, Steve. Great to be back.
Well, it's good to see you back because we keep bumping into each other, and you're one of those kind of big personalities that's out there, and we read your tweets and we see all the rest of it. First of all, for those people that know nothing about LawyerFair or about Andrew Weaver, a little bit about Andrew Weaver.
Well, my background is in legal and professional services, so I used to run a barrister's chambers for my sins many years ago up in Manchester. And over the last 10 or so years, I've been involved in professional services, both as a corporate finance advisor, or corporate deals advisor, I should say, but also investing in my own family businesses and in one or two companies outside of the family portfolio. So steeped in professional services and SMEs is probably the best way to describe me.
Right. So that's what you've been doing. What about LawyerFair then? Tell us a little bit about that, because this is just one of a number of businesses that you have. But is this the primary one?
It is. I mean, I'm really a bit of a fool. I've got dragged into a startup again at my handsome age, Steve. When it's hard. 23. Yeah. Well, I was 23 when I came last year. Raising this fund has aged me a little bit. But LawyerFair is something I'm quite passionate about. It's about matching the legal needs of business owners with really good quality lawyers. And certainly as a business owner myself, I felt that there were some occasions when I would have loved this service. And I think if you can launch a business that you would have loved to have used yourself, that's a pretty good thing to do. And also I'm pretty motivated in what I think we can achieve. And that's been partly why I've been motivated to launch it and also to go through this fundraising process. Before
we talk about the fundraising and the process that you've been through, I mean, you said that your background was working in chambers and actually doing to a certain extent in a day-to-day basis what LawyerFair is trying to do for the people that come and visit it on its site.
Indeed.
Do you see the development of that kind of site really is the future for the way the legal profession is going to be going? I mean, if I'm a business and I need a lawyer, is going to somewhere like LawyerFair.co.uk, is that the right path for me to take?
Well, the issue for LawyerFair is the long-term ambition is actually that we want to provide a suite of legal solutions or access to legal solutions. Two key drivers for us is access and cost. Can we increase the access of information and availability of good quality information and reduce the cost? Because a lot of businesses don't even use lawyers because they find it prohibitive both in terms of expense and access. And those that do use lawyers, some of them think they're a little bit too expensive. So I think there is and it's also a very opaque market. So all of these different constituent parts make me think that LawyerFair is very necessary, but we're going to try and create it as a platform for the right legal solution alongside getting the right lawyer.
And that's really important, isn't it? Now let's look at the business in general. So what we can do now is that we can unplug the fact it's LawyerFair.co.uk, and really the experience that you've had when it's come to funding this could be applied to your business, any business, couldn't it?
Well, maybe not. I mean, we're talking here specifically about seed funding. So we're talking here, and there are certain types of business that is perfect for, and many that it isn't. Now,
can we differentiate the different types of funding that are available out there that people will recognise when they hear it?
Well, you've got your traditional forms of bank funding, asset-based funding, even invoice finance funding. So those are very traditional routes for what I would call more established businesses to raise cash, and I've been involved in those over the years. But this is about seed funding, so it's really about companies that are very young, very early, maybe products that are very early. Some of them might not even be in the market yet, and it's about how do you get the cash, and this is the key question here. Traditional funding, you've got an asset of some kind, you've got some market credibility or financials that you can base with confidence what you're going to do. With most people who go for seed funding, and most companies and individuals that go for seed funding, you have no track record.
So what are you selling here? Are you selling the potential of a concept, or are you selling an embryonic business that people can see will grow?
Pretty much all things. I mean, investors will look at different things. They will look at, some investors will invest in the person. If they see a really, really impressive individual or team, clearly the product needs to be pretty strong as well, but they may actually say, well, actually, these guys can deliver something with this product that perhaps 99% of the population couldn't do. So a lot of investors will look at a very rounded view of the team as well as the product and, of course, the opportunity. And it's very much the package that you're presenting to them as an entrepreneur or as a startup entrepreneur has to try and capture all of those different things, because different investors will look at different buttons that impress them.
Well, it goes without any question of doubt that when they were investing in LawyerFair.co.uk, they were truly investing in you.
Well, you're a true charmer, Steve. I appreciate that very much. I'm gonna save that and send that to my mother. Let me say.
Well, there you go. Yeah, save it for your mum, but let your mum see it. When you started doing this, you must have looked at all the different avenues that were available for the startup company to actually be looking at funding. And of course, you went down the seed funding route. What other options were open to you? How else could you have done it, do you think, at the time?
Well, okay, let's go right.
And let's talk about what you were getting the funding for as well.
Yeah, no, absolutely. Let's go right back to square one. What we're talking about here generally in what we call the startup space, and startup is a bit rock and roll at the moment. I mean, Silicon Valley and Shoreditch, if you haven't got a beard, frankly, you're not very cool and trendy. But the world is all about startups, certainly in business. And what most startups are is a blank piece of paper. You've got an idea, you've probably sat in the pub with a mate and said, I'm really frustrated with lawyers, as we did. So you've got a blank piece of paper. So where do you go from there? Now, remember that every time you raise money, you lose part of your company. So you've got to try and do as much as you can on your own merits and your own finance. And that could be everything from your own funds, family funds, even, dare I say, occasionally credit card funds. Try and get that business up and running as far as you can with your own finance. Now, the problem with traditional funding and with the very early stage businesses, they won't look at it. They're not interested, because most businesses in this space some of them haven't even got revenue, let alone profitability. They probably haven't got any assets at all. So it is very, very high risk stuff in terms of investment. And it's called, there's a phrase for it, it's called the valley of the death, which essentially is this startup phase that from an investor's perspective is incredibly high risk. And you're trying to say to them, look, brilliant team, great product or service, fantastic opportunity. Well, what's your revenue? Well, there isn't any. Those are the three component parts of what I'm offering you. So that's a pretty tough thing to sell. The good news is that the people in this space understand the risk. They understand that you haven't got a lot of traction to show. So they do understand that the things they're dealing with are slightly nebulous, slightly difficult to feel and see. But you're selling them yourself, the product and the opportunity. And if you get those three right, there are lots of opportunities to raise seed funding at the moment.
Which is interesting. So continue. Yes, you were just about to take another breath.
Well, I was about to take a breath and hesitate because I thought you were about to interrupt me there. But I thought also I wasn't fully answering your question, because then, having exhausted your own funds, and clearly there is a limit to what you and your family perhaps are going to allow you to invest, you'll probably reach a ceiling fairly quickly with that funding. So then where do you go? Well, the two key areas for startup businesses are seed funding, which we're going to discuss in some detail, and increasingly over recent years, crowdfunding, which again I'm very happy to go into a little bit, although...
So what made you go the one way or the other? I mean, we hear a lot about crowdfunding, and there was a very interesting comment that you made, and I hope I'm okay to say this, but before you came in, while it is regulated, there isn't a lot of information out there for the people who are investing into it. So somewhere along the line, a lot of people are going to get their fingers burnt when it comes to crowdfunding. While crowdfunding seems to work for a lot of people, and it does seem to work, there are issues with it as well, though, aren't there?
Well, there's a huge debate about crowdfunding. I'm a great fan of it for certain scenarios and for certain companies and situations and products, etc. The concern, I think, that's been expressed is that there's not a huge amount of understanding about the risks that are involved. I mean, I've just mentioned the valley of death. I mean, there are lots of stats out there, but generally it's kind of accepted in the investment community that 8 out of 10 seed-funded businesses probably won't survive. So that's a very high proportion of failure. And I don't think always that people who, perhaps investors that go onto crowdfunding, are always fully aware of that. That's not a criticism of the crowdfunding platforms, because I think they're excellent, but it's just a fact that people get carried away by the herd, etc., etc. So I think there are issues there about how people, whether they understand what the risks are in seed funding. It wasn't particularly attractive to us for a couple of reasons. The primary reason is that we weren't just looking for cash. We were very much looking for people as well. We were looking for the right type of investor who could get on board with us, not just in terms of investment, but in terms of their network and their expertise. So we, in fact, as we'll come to, I'm sure, in due course, we got an investment, a fund manager who's on the board with a very, very good, strong network. And most of the companies that we're competing with, or our peers, are working with organisations where, again, there's a huge amount of added value. So for us, crowdfunding wasn't the right route. It is for many small companies and startups, and even bigger companies now who maybe have a separate product they want to launch.
And it's interesting, isn't it, with crowdfunding, what you tend to see is you see a lot of people going out there, maybe even established brands that are going out, and for a particular project, they will crowdfund, and or if they're launching a new product, they will crowdfund that. So that's very interesting, because it's horses for courses again, isn't it?
Indeed.
And I like the idea that the fact that when you go out and you're doing the seed funding, what you're looking for is that you're also looking for the expertise as well that's going to be there.
Indeed.
But is that in general the norm? I mean, when you seed fund, are you also going to get someone who's going to invest into you?
Whether it's the norm, it was very much what we set out to achieve. So I can't really answer whether it's the norm. I think there's a mixture, clearly. There are a number of SEIS funds that are available, which is something, again, we can go into in more detail. But these are fantastic schemes, SEIS investment schemes, that enable the investors to get great tax relief, whether it's successful or not, which is fantastic, and it's money that's available to entrepreneurs. So there are various schemes of fund managers out there where they don't necessarily have a major input in the business. So again, some great schemes, some great funds, but not necessarily right for us. Similarly with crowdfunding. So we were very focused on wanting to work with an investor who could provide the added value of their expertise and their network, and actually also perhaps the option of follow-on investment, because again, you don't want to be over-raising too much money. Is that right? Over-raising. Yeah. You don't want to raise too much cash.
It's an interesting. Yes, it's an interesting. Can you get too much money?
It's an interesting mangle of the English language, I think. But anyway, you don't want to be raising too much cash, because you're giving away a lot of your company at a very low price, because you haven't got anything to show. The valuation of a startup business is very difficult in the first place. But so you want to raise exactly the right amount of cash, if that's possible. You don't want to be raising too much, and so certainly from our perspective, we wanted to pitch it at the right level of cash with the right fund, who could then maybe invest in a follow-on raise to come, and that's what our investors can do.
A lot of people, their only experience that they're going to get of giving, because I suppose this is where you start, isn't it? How much are you going to give away of your business? And the multiple of that is how much you value it at that point. And we often see this on the TV program The Dragon's Den, don't we? Where people come in and they will overestimate the value of the business today, and what they're kind of doing, they're estimating on the value of the business maybe in 3, 4, 5 years time. But today, when they're standing in front of that particular investor, the business value is probably zero, and they're asking for this amount of money for that % of the interest. Is there a rule of thumb on how much you give away? What should you be looking at? Because some people would say, long question, short answer, some people would say it's better to have 50% of a success than to have 50% or 100% of a failure.
Well, with me, you're not going to get a short answer, so that's the first answer.
I appreciate it.
The second short answer is actually, it is very, very individual to the negotiation between that product, that service, and the investors, because, frankly, Dragon's Den investor is going to be worth a lot more because you're going to get that incredible spike of publicity and support for the business. So yes, the currency of a celebrity brings with it probably more equity than you want to give away. But there's a couple of golden rules I think you can probably apply. One is, it depends a little bit on your ambition. Our ambition is to raise more money, is to get a level of traction with this seed funding that's seeing us well into the next 2 or 3 years, and then to raise money that will enable us to really scale quickly. So we know that we're going to go through this phase again, which means there's going to be another slice of equity. So you've got to remember that what you're giving away now and the value that you're agreeing now may well impact on what you can achieve in the future. So be very, very cautious about giving away too much, and also frankly valuing it too high, because if you valued it at a very high level, then the next guys that come along are going to say, well, goodness me, I'm going to struggle to meet that valuation today, let alone a year ago. So golden rule, you really don't want to be giving away 20% or more than 20% at any one moment of a fundraise, because you've got to give away more. Depends on your ambition. But I would say if you try and target 10 to 15%, that's probably realistic. But the value that equity slice reveals is about the individual as well as the cash that you're getting.
Well, you're watching Business Connections Live. It's great to have your company, as always, on the programme. Here we are. My guest today is Andrew Weaver. Good to have his company with us as well, for that matter. And Andrew, of course, is from lawyer comparison site LawyerFair.co.uk, and he's sharing his experience of the pitfalls and the perils of funding. You're watching Business Connections Live, as I said, and we are live every Monday lunchtime. On last week's show, we spoke to Nikki Butlin from Athena Business Services, and she was talking us through franchising your business. It's another issue, another area perhaps that you can investigate when it comes to actually looking at funding and franchising and getting your business out there to a larger market. My guest today is Nikki Butlin from Athena Business Services, talking us through the processes when it comes to franchising your business.
What you're looking for is a business that can be replicated anywhere across the country and potentially around the world, if you're looking into international franchising as well. It doesn't stop there. As a franchisor, you've got to have your head office support team in place. You've got to be continually innovating your business. You've also got to be working on the products and everything and supporting your franchisees through their growth. That's one of the reasons they've bought into you in the first place, is because some of them could potentially go off and do it on their own, but they've bought into you because they want you as their business mentor. They want you looking after them. They want to come on the ride with you. Have you been trading for about a year or more? Have you got proven sales and marketing routes? Are you in profit? No one's going to want to buy a franchise if you can't make money from it. Have you got a brand that can be replicated anywhere in the country? Those are the 4 main things I think we would look at first, and then we talk about the discussions and exactly what your business is. And then we start looking at is there anybody else out there at the moment that's doing exactly what you're doing? You might look at franchise fees across the rest of the industry and go, they're selling a franchise for £20,000 plus VAT or whatever. That's great, £20,000 in your pocket. But actually, no, you've got to reinvest. Part of that money is for the equipment that you're going to give them, or the amenities and that sort of thing. And then you've got to help them market and everything. A franchisor will end up earning their money off the management service fee. So a franchisee will come to you, they'll buy the franchise package off of you, what you've already set the fee to be. So thank you very much, I've bought your franchise package, you've trained me, you've set me up, I'm ready to go and set up your business in my local area. The franchise agreement is the binding legal contract that ties your franchisor to your franchisee. It's normally for a 5-year term, some can do 10, some more. But if something goes wrong between that relationship, that's where it comes back to, and that's where things go through the legal process. So that's one thing you have to have definitely in place, is a good franchise legal team behind you, and get that franchise agreement in place. The other thing is the intellectual property, whatever your brand, your logo is. When we do those initial building the infrastructure, it's getting those registered with the Intellectual Property Office, so your logo. And again, for a business owner that might be thinking about it now, even if you're not quite ready to start the franchise launch now, it's start thinking about your brand and your logo. Is it unique? Is it snappy enough? Are the colours right? Is it going to stand out when you're at an exhibition and you're competing against 100 other franchisors for the business? That's the product, but it's also defining what price you're going to sell your franchise for, because what's included in that. And there will be an element within that package for the license fee. You're selling the intellectual property and the brand, and the rest of it is made up with however much training you're going to provide. Like I say, is there going to be a van included if it's van-based? Equipment, software, marketing. A lot of franchises will give 500 business cards, 1,000 leaflets in the initial franchise package to get the franchisee up and running. When we're at the earlier stages, that's why it's important to have the trading history, because if you've proven that your business works in your area and those are your trading figures, those are the first things that we're going to use to build up the projections for the franchisee. And then we underestimate them as well, erring on the side of caution. So if somebody's overdoing that, they're overperforming. And then once you're built up to the first 5-10 franchisees, you're then collating all of their data to use that to recruit the next batch of franchisees. What you want to do is test everything that you've set in place. You want to test that the infrastructure works. So all those parts in planning stages 2 and 3, with your franchise agreement, your operations manuals, your sales and marketing routes, the leaflets, all those kind of things. It's essentially a guinea pig, really, that you're taking on, and because of that, you're going to give them potentially a reduced franchise fee. I'm Nikki Butlin from Athena Business Services, and I provide franchise consultancy to businesses that are looking to take their core business through to franchise launch. The big takeaways that I can offer you are really do your homework in the first instance, research your own industry and research the franchise market as well, so who else is out there doing a similar thing to you, and just do your homework, put lots of planning in. Don't stint on spending the money at the early stages, because it's pretty much guaranteed that it'll come back to bite you in the end. So do your homework. Thank you.
And as always, we'll give you a reminder of what was on last week's programme. That was Nikki Butlin from Athena Business Services, and she talked us through franchising your business. Just a quick plug for what's happening on next week's programme. We've got Michael Graham from MJB Graham with advice on business and sales development, coaching and training. He makes a bit of a claim, actually. He says you can double and triple your sales. Double and triple your sales is what he's talking about.
That's quite a claim.
That's quite a claim, isn't it? He's going to be with us on the programme next week, and we're looking forward to that. So it should be an absolutely fascinating show. OK, I'll tell you what we're going to do. There was a graph that you gave us earlier on concerning the way this all works and the different stages, Andrew, that businesses go through when they're actually financing their business. This is it. It comes from, it's actually from Wikipedia, this one. We'll go back to the main site in just a moment where we found this from. But it's revenue versus time. And where would you say your business is at the moment? If we look here on this particular graph, we've got this Valley of Death. Is that the traditional in the garage, in the front room, where you're starting your business? Yeah,
and as the startup entrepreneur, you're also involved in what's called the trough of despair when you're down in there.
The trough of despair. They sound like film titles, don't they?
Yeah, they do. Well, when you get to the bottom of that curve, that's what you feel like, because you don't think anybody's going to invest in you. You've got a brilliant idea, but anyway, the Valley of Death is actually more a term, and it's a very important term to think about in terms of the risk profile of your business, because that's what the investor views you as when you're down in there. So, businesses that can't raise the cash clearly are not going to survive. But even businesses that raise the cash, and I see that the red and the dotted blue line kind of intersect on break even. Break even is when you're beginning. That's in a sense what you're saying to the investor. Look, give me the cash that will get me the traction to break even and above. I can prove to you that there's appetite for this business, prove to you that there's appetite and there's a great market opportunity. You can see I'm a fantastic guy to run it. So I'm talking generically here rather than personally, Steve. So you've convinced the guys that it's a brilliant opportunity. Get me to break even, allow me to have the cash that's required to get to break even and above. Because the reality about particularly online businesses like ours and yours, Steve, I suspect, is it requires quite a lot of resource to get you some real online traction, and that requires funding. Certainly from our perspective, it did and does. So you're basically saying to them, look, this is the opportunity. These are all the factors that why we think it's a fantastic opportunity, but that they look at it as this is a sector that's very high risk. Hence the Valley of Death, which is slightly tongue-in-cheek, but probably is a very fair assessment of where most businesses at this stage are in.
Where do you think obviously once you get past this point here, the break-even point, risk starts to diminish, but I would imagine, I'll just get it back in the middle of the screen again, but I would imagine that what we're talking about is that we're still at huge risk even as we're going up here. In fact, all businesses are at huge risk because you never know how circumstances are going to change. Is there a moment that you can breathe easy for a while, or do you breathe easy here because you've got the investment and you might breathe easy every alternate week as you work your way up this particular graph?
Yeah, I mean, it's a good question because there's no doubt from our perspective, raising the seed capital was crucial. You know, I'd be working probably on a beach in Barcelona now if I hadn't have raised that seed capital. You know, it really is absolutely pivotal for us was to raise the seed capital and sufficient amount of capital to give us the runway to do what we want to do. So, I mean, to some extent, I am breathing more easily now than I perhaps was pre-completion. But clearly, the risk factor, it doesn't particularly get ironed out that much until you really are at least a sustainable business model, which again, at very early stages, you're not really. I mean, we're still trying to find our exact, what they call product market fit. So we're still trying to find the exact model that we think is going to be scalable. And again, that's part of what the seed funding is about, that we want to explore and investigate certain areas of revenue that we perhaps didn't have the chance to before. So breathing easy, yeah, it's been fantastic to get the funding, it's been fantastic to get the backing, there's confidence and credibility that comes with that. But all we're doing really now is driving to the next stage. And I suppose I'll be running 7%
away that you've got left or whatever
possibly
it is.
Right. And I'll probably be running out of breath as we get closer, which is a very good point actually, because this is a time-consuming process, raising cash. So again, you need to map out very carefully when you're going to raise it, because it's a great distraction. So we will probably have to go through some of this again in we hope, 12 to 18 months.
Okay. Well, in that case then, let's just step back for a moment then and look at that initial process. We've decided that we're going to go the seed funding route, and we see that as being very, very important. We decided we're not going to do crowdfunding, we're not going to go to the banks. We feel that we're an internet business, or we're a business that actually could benefit from the seed funding model. What do you think, and what you've seen, are the big mistakes that people will go through, or the things that they don't do when they should be prepping to actually go for that funding? Where do they go wrong? I mean, you said you found it a bit of a roller coaster ride, and you've been there. You've raised finance and capital in the past. How different was it this time?
Well, I certainly underestimated the time. I certainly underestimated, I think even probably was a little bit overconfident about what we had and the market space that we had. You know, we've not got proprietarial technology, you know, we've not got something that you can immediately hang your hat on. We think we've got a really good service and team, and there's an opportunity. So perhaps, you know, I underestimated the time and energy that it would require. And of course, there are no guarantees at the end of that, that you're going to get the fundraise. So make sure that you build that in, and make sure that you're not taking your eye off the ball of the business. One of the things that we did was we waited sufficient amount of time that we had very clear market evidence. And what I mean is this. We've got one or two pieces of strategy that really fell into place for us around about the middle of last year, early autumn, when it finally fell into place. A couple of strategic initiatives that came through. Now, they weren't confirming that this business is going to be successful, but they did show very clearly to potential investors what was possible. And again, it's about timing. Now, the key with that is that if you then leave it 6 months, you never know with startups, you're going to go up and down like a yo-yo. You've got to make sure you're not going to that investor when you're beginning to go through a small dip. So I think it's quite important. If you see on the horizon that there is a clear win coming up for your business, that's a really good time to think about going to meet investors, because it's really difficult. 6 to 8 months, anything can happen. So timing, being aware of how long it's going to take. So could you see
that? You had a couple of wins in the autumn.
Absolutely.
And so you felt you were in a position
very much so.
Approach the investors.
Yeah. We'd made a couple of meetings in May or June, July even, I think, and we'd begun to get a sense of what we needed to have in our armoury, if I can put it that way, to really make this work. And that's why we hung on a little bit longer than perhaps we would have wanted to normally. And we started to go out and fundraise in the autumn on the basis of these two strategic things coming home.
On the amount, deciding the amount that you go out for, I've been involved with consortiums who have gone after local radio licenses and things like that. It was really interesting. And also, as it turned out, we wanted to launch a retail TV channel, which was a really interesting experience. And we went out with the business and we took it to the city. And at the time, I think we were asking for X amount. And on reflection, I think what we should have been doing is probably, now looking back, it's easy, 2020 eyesight when it's retrospective, but we should have been asking for double the amount of money that we were asking for. As it turned out, we then got into bed with somebody else, a large newspaper company, and we ended up doing a lot of work for them. But the thing that's always went through my mind is, do you think a lot of companies go out there and make the mistake of not asking for enough initially when they go out, or do they ask for too much?
Well, it goes back to the point we raised earlier, in that you're giving away a lot of equity at this stage. Your negotiating position isn't particularly strong unless you've got this amazing product, or your revenue is going through the roof, which for most people at this stage it isn't. So you're not in a position of strength from negotiation. So you really want to make sure you're forecasting as clearly as you can. Now let's be honest. If you're doing an online business, raising even 200k is not going to give you an awful lot of runway. It's going to give you 2 or 3 people and a laptop to really drive the business forward. So be absolutely realistic. You're not going to be able to start paying yourself 75 to 100k a year. So you've got to create a forecast that is realistic, that has its sensitivity in there. Maybe you're not going to get revenue for 6 months, but do not over forecast, be overconfident about your forecast, but do not also try and forecast in 4 years' time, because it's complete nonsense. It depends on your.
Do they look for it though? Because the banks will still, won't they? They'll be looking for your 3-year best guess.
Yes, they do, and we forecasted for 3 years. But I think everybody in this space understands that is.
But actually, you only know
that.
What's going to. You don't even know what sometimes is going to happen next 12 months.
You don't even know what the model will be in 12 months. In truth, so But the point is that everybody in this market space kind of knows the rules. They kind of know. This is partly why this conversation is, I hope, useful. In that everybody kind of knows 3-year forecasts are difficult with an established business, but they're almost impossible with this kind of business. What they're looking for is how you think. So how you think about the forecast that you create is way more important. In fact, it's the only thing they really look at. So what are your assumptions? Have you decided you're going to buy everybody a Ferrari? Have you decided you're going to buy 3,000 square foot in Sloane Square? Hopefully not. Hopefully you're adopting. I mean, I'm a great fan of something called the Lean Startup methodology. There's actually a book called the Lean Startup book, which is a fantastic book. Actually, I think corporates would do.
Is it a really good book?
It's a really good book. I really recommend it.
We're not plugging anything on today's program.
I'm going to buy you a copy.
By the way, here it is. Eric, is it Eric Rees?
I'm not sure.
Penguin UK, the Lean Startup. Most new businesses fail. Most of those failures are preventable. The Lean Startup is a new approach to business that's been adopted around the world and built from companies that are building new products and that are launched. Now, you said that this was a really useful book for you, actually.
Yeah, I mean, I didn't come particularly from a lean business methodology. There's a lot of common sense in operating your business in a lean way. What they're really getting at here is about when you're building a business, build it based on real market feedback, and don't over-engineer it. Don't over-engineer your website until you know that the service that website is providing is one that the market wants. So it goes back to what I mentioned earlier about product market fit. So essentially you are building as you're learning, and you're not overextending your resources in areas that aren't going to give you any return. So yeah, it's still hit and miss. You're still going to end up, but that's partly what it's about. I'll give you a quick example. You have marketing channels, which clearly for online businesses are absolutely crucial. You're probably going to be looking at 14 or 15 different channels with which you want to experiment. So you just dabble with them all, and when you find the 2 or 3 that gives you the return, you then go deep on those 2 or 3. So it's being very, very lean in the way that you operate until you find clear evidence that either there's appetite for that service or there's a return on that particular channel of marketing, as an example. So that's really it's about bootstrapping. It's about financial control. But the way you've run that your startup through that, what I call a minimum viable product stage, will be very, very important in your discussion with the investors, because they will be looking at how you've run that and looking at how you've taken that research and market learning into the forecasting that you do. So clearly 3 years time, I don't really know where we're going to be, but the assumptions I've made have helped convince the investors that I'm the guy who can deliver it. So
let's summarise where we are then. So you bought the book, and that answered all your problems. No, seriously. So let's summarise where we are. We've got ourselves a potential product that we feel is going to be an absolute winner, and we run that, or we get that as far as we possibly can, because we want to see a working model to see if it does have legs and it actually will fly. Legs and fly, so many metaphors there, but you know what I mean. So we've developed our brand, we're developing what we've actually got to get it to a particular state. Then we take that to, we look at what's available, what investors are out there. Do we go to the bank as a form of investment and take out loans? I would imagine. Got to be. I don't think many banks on that kind of investment would actually be coming forward. You'd have to be mortgaging your house, wouldn't you?
They'd want your house.
They're going to want real guarantees behind it. You look at the different forms of funding. We've got the crowdfunding that is sitting there, and you've also got the seed funding that is also available to you. You then put together effectively your business plan that is looking forward.
Can I stop you there? You're absolutely right with business plan, but this is one area that so you've almost statuesque. That was good. No, but the reason I picked up on you, because I'll forget to do it. Business plans are the one thing that you should not spend any time on.
Oh my God, that is really controversial.
The amount, and I know this actually from previous life and investments that I've looked at.
There are people screaming at their laptops, PCs and TVs.
I'm telling you now, if in this space, if you're raising cash from seed funders or in future from VCs, they get hundreds of these business plans, hundreds of them. They don't read them. So you're sweating and probably poring over those spreadsheets and doing your sensitivity analysis till 12 o'clock at night, and the family are screaming at you. Does the VC care about the effort that you're putting into it? Probably not. So what you've got to do is think really, really efficiently about the information you need to get across. By all means, if you want to do a business plan, but make it extremely short, what you should do is do what's called a pitch deck. It's kind of industry speak, but it's essentially a PowerPoint type presentation of no more than 10 or 12 slides that goes straight to the heart of the issues we're talking about here. So it's, what's the product, what's the opportunity, what's the team, what do you want, what are you offering? And if you do a pitch deck of 10 or 12 slides, I'm guaranteeing you now, it may take you half a day, it'll save you the 3.5 months you've spent trying to fine tune that business plan, and it will have a much bigger impact. There you go. You can carry on now, Steve.
But obviously you've got to do your figures. I mean,
yeah, of course.
I mean, you sat down as well.
But we're talking here presentation, not about the figures.
I'm sure that Excel was a very important tool that you were using for a while.
Yeah, it's been my life for the last 6 to 12 months, if not longer.
But a really good piece of advice. So a pitch deck is what we're talking about. 10 to 12 slides with the core. Here's what's in it for you. Here's what we're doing.
Absolutely. And listen, I'm very happy after this event. If anybody's interested in or wants a bit more information, if they want to email or get in touch, that's fine. The point that's really important to make here is I'm not talking about not investing time in the financials or not investing time in getting information and market feedback, etc., research. I'm talking about how you present it to the funders. And they are not interested in a 35-page business plan tome that will go in the bin. Maybe an executive summary, maybe a little bit of paperwork that follows it up. But in my view, you're much better off exec sum of 2 or 3 pages that really hits the nail on the head of the key parts of your business, and a pitch deck, and that's it. And start moving on that. If you find that an investor goes, this is great, but I would have loved a 35-page business plan. Great, go out and do it. But again, it goes a little bit back to the lean startup, and this is only from experience, let me tell you. I have sweated, as my family will tell you, about business plans and financial spreadsheets until the wee small hours of many a day. I don't think it helped me at all.
The process then, when you meet a potential investor, the process that you go through, how do you meet them? And what happens when you go in for a typical meeting? And what were the big mistakes that you made when you were going through the process?
Well,
it's like an act of contrition.
I'm chuckling to myself because I wrote a blog about pitching to the wrong type of organisation, which was I got a phone call late at night. It was very early in the process. This organisation, which I can't name, but I call them Sexy Capital. They're based in the heart of Beard Country in Shoreditch, and they gave me a late night call and said, "Come on over to our cool place in town and do a presentation tomorrow." Now, so I thought, well, this is it. They're obviously going to fall in love with me and my idea. This is obviously a presentation to their main board of directors, main decision makers. So I stayed up all night, frankly, and got this thing sorted. And anyway, went in and it was a complete disaster because they weren't the right fund for me. They were very much involved in high tech stuff, and I think to some extent I was a filler for someone who dropped out clearly. So and I ended up being.
How long did you have to present?
Well, that's a good question. I assumed it would be a lovely face-to-face meeting, but I was kind of perched on the end of a table whilst there were skateboarding millennials going around me, being interviewed by a chap who was born when John Major was Prime Minister. So these are the kind of things that, you maybe need to do a bit of research on. But I'm joking. They're actually it's a very strong fund, but it just wasn't right for me. And because I hadn't done the research, I hadn't thought about it, I just went gung-ho. So that was one very tiny example. So certainly there are certain types of fund that you need to look for. And again, it comes down to the right fit as well. Mm-hmm. But certainly in terms of meeting and finding out this kind of information, it really is just, the internet is pretty damn good on these things actually. So if you just look at seed funding groups, there are meetup groups, there are angel funding organisations. I mean, just for one example, the UK Business Angels Association, if you log on with them, you will be able to find from them a huge resource of angel networks, angel associations, and such forth. And from there you can start to build your understanding of who to see. The other quick point is the SEIS stuff, which we haven't really gone into.
No, we haven't.
Which I'm happy to later if you want.
I'll tell you what we'll do. Let's talk about that in just a few moments' time. Okay. Just a little bit of housekeeping, I suppose, really. Just a quick reminder, if you're finding this fascinating, next week's show, Michael Graham from NJB Graham. We've mentioned it earlier on, but with the right sales and business coaching, you can double and triple your sales. That's what he says. He'll be on the show next week. He's going to be talking about that. Something that I do want to point out to you, by the way, is the Business Connections Live. We've got a brand new website that we've just put up recently. You can go onto the website and have a gander. Just let me refresh the page, and then you'll get the front page. Hang on a second. There you go. Thank you very much indeed. And you'll see what we're talking about. If you want to find out and you want to see all the different programs that are available from Business Connections Live, you can simply go along to the website. Here it comes now. It's coming up. Thank you. Any second now. Just a little bit too quick on the buttons. It'll give you all the insight that you need on the different shows. It'll tell you all the times. I'm sitting here, and there we are. It is all coming alive. Some of the quotes from some of our past guests that have been on the show, and also who have been involved with Business Connections Live. The fact that we're going to be broadcasting over the next couple of weeks, we've got the Business Show 2015. That's going to be happening in December. And do come along and see us as well at the live show, the TBNS show in Wolverhampton. That's going to be a cracking event, by the way, so go along and see us there. And as you can see, all the different programs are all lined up on the site. Very easy for you to go back and look at some of the old shows. We've got a selection on the front page, and we've got a complete archive of all the old shows. The other thing that we've included on this brand new site is a whole load of what we call business resources. Now, business resources are there for you to use. They're opportunities for you to come along and maybe talk to us here at Business Connections Live. We'd like to maybe share some of the experience, the expertise that we have from the field that we're in. Remember, the background of this business, our business, is business, legal, and broadcast. That is the background to what we're all about. And we like to share the skills that we have within our business with yours. Now, for instance, one of the things that you can do is that you can actually have your own program, your brand TV. So if you're enjoying this particular show and you're thinking to yourself, do you know what, I would love to have a show just like that one, but with my branding all over it. Still sending out conventional newsletters to customers?
Do you just want a more engaging way to talk to your customers and employees?
Hello, I'm Steve Hyland.
And I'm Linda Bazant of Business Connections Live.
Your Brand TV is a completely branded television show that can be streamed live or delivered on demand to your niche audience. Be the first in your market to capitalise on the online media gold rush that is using online video to effectively deliver news, information and education to key personnel and clients.
Video attracts 2 to 3 times as many monthly visitors. It doubles their time spent on your site and has a 150% increase in organic traffic from search engines. Large networking organisations are already utilising the power of Your Brand TV to market, promote and publicise to their members and groups across the UK.
Your programme will be branded with your corporate colours and logos in your own broadcast quality network studio.
You can choose the format. It can be news or magazine or interview in its look and feel.
You can have live guests on your show, or you can Skype them in.
You can stream the show live or on demand, so it's available for catch-up.
This is a chance to deliver your message in a new, exciting format that will allow your business to cut through the noise and stand out from the crowd and engage your workforce and customers. This is Your Brand TV.
To get more information on this fabulous opportunity to bring to life your corporate communications, contact us today at Business Connections Live, the UK's leading online business channel.
If you want more details for that, simply go along to the website, find the link. It's under Business Resources that says Your Brand TV. And the other thing as well, is one of the things that is it's just a real hang-up of mine actually, is there are a lot of people out there that think that business video means standing in front of a camera, doing a talking head, shouting at you in a very fast voice in 2.5 minutes with sound that sounds like it's recorded in the toilet. When you put something up online on video and it's meant to be professional and representing your business and your company, you are not being compared to people who are putting up cheap 2.5 minute videos that they've recorded on their iPad at home in their living rooms. Everybody, regardless of whether you realise it or not, you are being compared to the national broadcasters. People will compare you, and in their mind's eye, without them even thinking about it, will be putting you in a scale compared next to what you see on the BBC. The BBC do a business show every night that lasts 10 minutes. They do another one at 10 o'clock. Yes, they have all the resources, but look at how professional that is. That is now within your grasp, that professional delivery, that identifying what your key message is and selling it in a persuasive way. That is within your grasp. If you are missing out on the opportunity of doing that, then have a look. We've got a sales video workshop where you can do powerful sales videos for your business. We'll have you here in the studio for a day. We will take you through the process of writing a script, how to present yourself, how to get your message over. And also, if you want to find out more details of that, once again, go to Business Resources and to our events and workshops that are down there. Just pop onto that and you'll find out more about that particular facility. All right, I feel like I've got on my hobby horse now, but we are absolutely passionate about the way you as a business present your business to other people. There's a lot of things that are said out there by people who really are just making an assumption. They don't understand how to deliver things. They don't understand broadcast. Here's an opportunity for you to be at the top of the game, to actually get a bit of an edge on everybody else, to stand out from that noise that is online at the moment and make certain that your brand and your product is at the top of the selection tree when you go out there and promote it. Go onto the website, it's businessconnectionslive.com. I know that sounded a bit like a speech, it wasn't meant to, but we are absolutely passionate about that. My guest on today's show is Andrew Weaver from lawyer comparison site LawyerFair.co.uk. We are not talking about the site, we are talking about the way that Andrew went about getting funding for it, seed funding for it, how he's taken the business. How old's the business now, Andrew?
We properly started at the beginning of 2014, so 18 months.
So 18 months. So you were in the business was running for what, 8 months? A year before you started really going out there? I'm very lucky in that the co-founder is involved in the VC community, so I was very lucky in that I had a bit of a foot in terms of understanding the metrics and the timescales. So we kind of thought about it 5-6 months. The only reason we held back was the quality of the information and the quality of the market feedback that we wanted to provide wasn't quite there. So it was around about autumn time we got that right. Can I just interrupt for a second, because I sat here listening to, can I say I love Business Connections? I think it's an absolutely fantastic resource, and you even get free makeup as part of the deal, which is thrown in as part of the deal. So I just want to endorse the fact that I think it's a fantastic resource, and Your Brand TV sounds awesome, frankly. So obviously this is my slot. I don't want to be promoting you too much, but just wanted to endorse to anybody who's watching that I do actually share your views. And I think the thing that's come over about all the programmes is the fact that, and I don't want us to get into this, I'm great, you're great too, but the situation is that all our guests that come on the programme, they are all legitimate business owners. And yes, and Andrew could have come on today and he could have sat here and talked for an hour. We actually wouldn't let him, but he could have come on and talk about LawyerFair.co.uk for an hour and promoted how great it was and how good it was. But if you watch all our programmes, that is never what we ask our guests to do. Our guests are about giving you that education, giving you that insight, so that when you go to do something, you now have a resource that you can fall back on. So that's the reason today we're not talking about LawyerFair.co.uk. Yes, that was the vehicle that went out and got its seed funding, but we are talking about the process that Andrew went through to get that seed funding. And I think, I don't know about you, I found it absolutely fascinating to where we were. So we've sat in front, we've done the interviews, the kind of questions that you're getting. If you've never been in that interview, and you've already said that you went to one interview in Shoreditch, and when you were there, they were skateboarding around you, the wrong funder. Two questions as always. A, how do you identify whether the right or wrong funder? And what questions do they typically ask you, so at least you can be partially prepared?
Well, it's sometimes difficult. In fairness, it's sometimes difficult to work out who the wrong funder is. But you can generally look at who they've invested in, and they will generally give a description of the kind of companies they're interested in. So, I'm all for going for everything. You never know. You might just meet the guy and it connects. So, this is not a barrier to going to see anybody. But there are different types of funds at different types and stages as well. So, again, you don't want to be burning. You burn a lot of time doing this process. You don't want to be burning it sitting in front of the wrong kind of guy who's just got you in as filler. So that was really the reason for that explanation. But actually, as with everything in life, Steve, it was a fantastic learning curve. So there's always something you can extract. But so it depends again a little bit on timing, a little bit on what you're looking for. This is very, very much a generic overview. But SEIS, which was what we referred to earlier, that tends to work very much around the financial year-end cycle or the tax.
So let's just talk about what those letters stand for. Do you know?
Yes, I do. It's you're impressed by this, aren't you? I'm now going to be caught short. No, I'm having a Green Party blank moment. Just for a second. So Seed Enterprise Investment something, SEIS scheme, I think. But essentially, it's what SEIS was, for those that are aware of what EIS was, and they've added on a
You'll
seed.
never forget that. It's so strange because I know what NICAM means.
Do you?
Yeah, near instantaneous compounded audio multiplex. But that's not important right now.
Well, I said that every experience was a learning curve. I'm not sure I'm going to remember that one. But anyway, so SEIS was introduced, I think, 2 or 3 years ago, and it is a brilliant scheme. It's a brilliant scheme about giving tax relief for investment in very early stage, and as we've said, very high-risk companies. So the people that invest in it can get, I don't know what the current figure is, it's something like 75 or 80% tax relief. The point is this about timing. The funds tend to get their money towards the end of the tax year, because that's when the investors, the high net worth investors, know what money they've got available to put into it. So with SEIS investments, with the funds particularly, there tends to be a race to close towards the last quarter. So again, if you're thinking about your timing and you think that SEIS funds are the way to go, then that might be an issue to consider. But frankly, there are lots and lots of seed interested investment opportunities at the moment. It really is a buoyant market. Doesn't mean it's easy to get the cash, and it doesn't mean you should skimp on all of the stuff we've talked about, but there is lots of opportunity to raise cash. I'll give you a quick example. There's a couple of other organisations, and I'll name them. I've got no connection with them, but Syndicate Room, as an example. Syndicate Room have a slightly different perspective. They want you to have already raised 50k. So they want you to come to, I think it's 50k, it's around that kind of figure, or it's maybe a percentage, but either way, they want you to come to them with an investor, and they will try and bridge the gap between what you've already got and what you need. That's one example. Mm-hmm. Someone else called Match Capital, who will match you with the appropriate funders. So there's lots of people out there that can help you piece the jigsaw together, so you don't feel you're alone. And there are lots of different vehicles that can do it. So what we're talking about here is really preparing yourself before you get in front of those investors. The type of investor may be very much down to you and what you need.
So did you find that you ended up talking to quite a few of the wrong investors, and when you found the right investor, what was their profile?
Well, yeah, I certainly...
is that what took the time?
Yeah, I'm just trying to think. Certainly I probably spent too much time talking to VCs, frankly. I probably was slightly over-ambitious in wondering what I might be able to achieve. remember, you're cutting a piece of your pie every time you raise cash. So ideally, you don't want to raise any seed funding. You want to go straight to the VCs, or Series A, let's call it that. So I perhaps made the mistake of thinking this little business, this little startup without much revenue, with a great idea and a good team could. So I had too many meetings with too many high-level people. I should have started very much at the seed round. I should have focused on a certain amount of cash, which was much lower than that initial expectation. So it was more the type of investor who was or wasn't, as it turned out, interested in me, that I probably spent too much time. However, again, it was brilliant learning, and there were one or two of them that gave me a little bit of a nod about, well, look, if you achieve something with this, come back to us.
Come back and talk. When you're looking for the cash, is, as I said earlier on, when we were looking to raise funding for what we wanted to look at, we went out actually looking up. I mean, it's quite a few years ago. We were looking for 5 million, and to be honest with you, on reflection, I think we should have asked for 10 million. And I think it would have been easier to have got 10 million, because people, it's just a different. You're stepping into a different area, a different part of the game part. Do you think the same applies when you're looking at seed funding? That you can actually end up not asking enough, and therefore that becomes derogatory towards your approach?
Possibly. I'm not sure.
Is there a percentage? I mean, can we? I mean, I'd write if you don't want to, but
no, it's in the public domain.
What was your original plan to go out for, and what did you eventually get?
No, it's in the public domain. I mean, I grappled with how much do I need just to build the runway that I need to get to the next level? Because again, we go back to the point about how much of your pie you're going to give away. So I grappled with, do I just raise 75k, or do I try and raise 500k? The reality is, for me, it ended up somewhere in the middle. We ended up raising 160,000, but with an option. There are various other little options of follow-ons that are involved in the agreement we have. So there is the opportunity of more. But actually, in the end, 75k wasn't enough. It wasn't enough to build the runway that we needed. So you might as well have flushed it down the toilet. And
you've got to be realistic about that.
You've got to be realistic. And let's not forget this, and it's a very important point which people forget, is time. The time of the entrepreneur is as valuable as the cash you're raising. So if you raise the wrong amount of money, or you raise it with the wrong people, for example, and it just doesn't work, it's you kissing goodbye to another 2 years of your life. So it's a really important decision to try and get it as right. You will never get it. You'll never know whether it's right until, again, 2020 hindsight. But time is a very important factor that entrepreneurs tend to forget. And it's not on my side in the way that it might have been in the past, Steve. So it was a really important factor for me, to get the right people. So I probably initially thought too little, then too much, and I ended up in the middle, which was, I think, and I hope, exactly right, based on what we needed, but I'm not giving away too much.
Do you think that's one of the mistakes that people make, that they become a little bit too ambitious, or they do overvalue what they've got? Or is that going back to the fact that somewhere there is some form of a business plan, where you've done some form of projections that do look forward 5 years, that does give the business that kind of value? Well,
I'm sure the members of the seed funding and VC community will concur with this wholeheartedly, but valuations and the expectations. I mean, valuations and sellers' expectations when you've got a proper established business are often wide of the mark. I mean, I think we had that discussion.
Is it then a two-stage process? I've seen this in other industries where you're effectively, dare I say, I'm going to use the wrong word now, but go with it, all right, where you're winning the money. So you've got the process where you are pitching for the money. This is what you're trying to get. So there's the pitching of the money, and then there's the actual using the money. So that sometimes doesn't relate that much to that. But it's got an association, but getting the money is one job, and then making it all work is another job completely.
Yes, I think I understand what you mean.
Well, there used to be another thing about, and I hate to go back to broadcast, radio licenses. When you would win a franchise, in the very early days, there were two stages. There was, you would promise the moon and stars to get the franchise, but then the radio station had to run as a business, and sometimes the franchise wouldn't allow that. So things would be adjusted.
I think a lot of this comes down to people. If you've got the right people who are interested in investing in your business, they will understand what you're going to go through. And what you're going to go through is almost certainly not going to be what you forecast. Hopefully, you're going to go through the roof, but there's a great probability you're going to run out of money or be getting close to running out of money. So again, this comes back to the very important issue of what's going to be a relationship with those investors going forward. And also remember that when you're pitching to that investor, you're on fine form, they're probably on great form, everything seems rosy. In the middle of December, when you're about to run out of money, are you going to have a relationship with that particular investor that's going to help you get over the line with that particular problem. So don't just think about it when it's in the rosy days of raising, but think about how you're going to communicate and get on. Is there a chemistry with these investors or the invest fund manager that's going to help you during the difficult times? So there are two relationships here. I think it's being credible, having a proposition that actually is backable, even though it's, as I say, high risk, having a valuation that is vaguely realistic. Valuing any business is difficult, as you know, but valuing a startup is really, really difficult. So there has to be goodwill on both sides to accept it. Has to be worth it for the entrepreneur and worth it for the investor. So finding that pitch is quite a challenge. But again, it comes down to the people. If the people understand the market, if they understand the motivations, they understand there has to be goodwill on both sides, you can come to an agreement. And then it's a question of, well, what support are they going to provide? Are they going to be there for you if you do run out of money? And listen, again, the realism is that you may do, but it doesn't mean the business isn't going to work. You know, there may have been uses of your resource that you weren't expecting, but actually still the graph is going in the right direction.
Is there a lot of money, do you think, out there?
There are lots of opportunities to raise money at the moment, certainly. I mean, startup sectors are very hot at the moment, and Tech City, as I say, very crowdfunding, the SEIS funding. There are lots and lots of people out there to help startups. So, you don't need to sit alone in your home office anymore in the way that perhaps 5 years ago it may well have been more lonely than it is now. Lots of funds out there, but also if you go in there with the wrong information and you don't have credibility, they'll spit you out very quickly. So you've got to get it right, but definitely if you've got a proposition that's of interest, there is lots of cash available.
And is it dictated by the market sector you're in? I mean, you're perceived as a tech market, are you?
We are
what do you
indeed,
perceive that? So where would you?
Yeah, I mean, we would like to think we're in legal tech. I mean, that's where we are. That's where we're heading for. And
is that now called fintech? Is it?
Well, no, I mean the similar kind of professional services.
Oh, that's financial.
Yeah.
Tech,
so it's essentially the same of technology taking dusty old professional services environments and revolutionising them. So, I mean, just to give you a quick example, in the US, the legal tech market, there was, I think, something like $65 million invested in 2013, $450 million the year after. So, there are certain tech markets that have a real bubble atmosphere about them, and if you're in that, take advantage of it, clearly. So the sector you're in definitely has a major factor on the appetite of the investor. Certainly if you're technology-led, then you're going to have a very good chance of getting an interview at least. And there are various other market forces. What's the competition like? I mean, we were talking earlier about attending the business show, and I was there a year or so ago opposite the Rockstar where they do the pitching.
Jonathan File.
Yeah, indeed. And the amount of people that came and pitched and said there's no competition in this market. Well, be realistic about what your competition is. Be aware of them, but don't start saying there's no competition. There's hardly any business in the world that has no competition. So again, be realistic about what you're presenting, about the information you're providing. But yes, the sector, the competition, the technology that you have, if you've got one or two real stars coming in the team, all of these factors matter to the investor.
What about the amount, when it all does go down the pan, when it all goes horribly skewy, wrong.
To all those other startups.
Yeah, because it always happens to somebody else, doesn't it?
Absolutely.
It's not going to happen to your business, but from the investor's point of view, I take it that they, depending where you're going, I mean, you were talking about the SIES, is it?
SEIS, yeah.
If they're part of that, they're actually quite protected, aren't they, to a certain extent? If you as a business go down and they've lent you the money, they're going to get some of that back, aren't they, through the government? So there are advantages for them. And I suppose at the end of the day, what we're saying is that they could either invest in you or give it to the revenue, can't they? Or somewhere else. So there are advantages to doing it. From what you've heard and from what you understand, what is the success rate?
Well, I'm going to come back to that question, but I've just realised, just in terms of the amount you can raise, SEIS, there is actually a ceiling. So you can raise, I think it's 150k is the ceiling. So that gives you an idea of what you can raise on SEIS. And I would probably say that's what people head out for generally if they're raising money through that. We raise a little bit more because we had a separate investor, but the main bulk of it was SEIS. What is the success rate? Well, it really differs. It's not high. It is not high in the start. Certainly in the startup, in the very early stage startup space, and even in the VC space. I think they'll be honest enough to admit, there isn't a high success rate, and therefore their calculation is to make sure that the ones that are successful make them the return. So there is a brutal reality about this market space. If you're starting a business from the back of a piece of paper and building it from there, there's a very good chance it won't be successful in the successful terms of an exit or selling or making a really fantastic financial return. Doesn't mean, for example, there might not be other avenues with which you can turn it into a success of some kind. And to some extent, we feel pretty happy with the success we've already achieved, raising it from zero. Stats, Steve, I really don't know. If you were to say 7 or 8 out of 10 struggle to survive, possibly fail, then I think the investment community would probably say that's about the right figure. And
is that a question that comes up? You kind of touched on it there. Is that something that does come up in the interviews? What's your exit plan? Well, it comes up in their eyes. You can see in the eyes of these guys that they've been battle hardened. I mean, I went to actually the investment team invited me along to do a presentation to some of their stakeholders, and the discussion was very much about the irrationality of investing in this space. It is irrational. The stats don't stack up that say you've got a high chance of success, which is why I go back to the crowdfunding issue about, are people truly aware about it? So it is an irrational space. It's an irrational space to be in as well as to invest in. But the people that invest in it really believe in it. And that's why actually I think, I don't know, I have not been involved in the VC world yet, but hopefully we will be. But I have to say the people who are involved in this market are very committed to the businesses they invest in, because they know there's a smallish chance that they might not get their money back. So all the people that invested in LawyerFair... Smallish, actually, there's a huge chance of if it's 8 out of 10... I've got to... my investors are watching, Steve. I've got to, yes. maintain the confidence. What have you done? I know, they're going to pull the plug on me tomorrow morning. Hello, is that Andrew? Well, we've got some bad news for you. Here's your P45. But all the people that have invested in LawyerFair really believe in it. And I think that at this stage, they have to. They've got to have great faith in you and the product. And actually, that's fantastic to have. It really is. And the support mechanism, which goes back to the point we made a couple of times, is who you get into bed with is just as important as how much cash they bring. Now listen, we're nearly at the end of the show, and it's been a real fascinating insight for a number of reasons from my point of view, but it's been a fascinating insight. And it's interesting, looking at what LawyerFair is, looking at the way... By the way, we haven't even shown LawyerFair, I don't think. I'm so focused on providing value, Steve. Yeah, this is the actual LawyerFair website, if you want to go along and have a look. Does your business need a lawyer? We compare lawyer and costs. You save time and money. Nice simple form to fill in there, and how it works. It explains what it's all about. There you go. Submit your legal request, compare fee proposals, select your lawyer, reviews with a difference. Now remember, it's not just that finding a lawyer, it's also finding maybe the information that you need on an ongoing daily basis. You may just need somewhere or some piece of information when it comes to the legal matters that your business is going through, or whatever you're approaching it for. So the resource is there, and that's what Andrew has gone out with, why it works, some nice information there. If you want to visit the site, the address is lawyerfair.co.uk, and you'll find out all the information about what LawyerFair is all about sitting on the site. There we are, we have shown it. Listen, before we go, we'd like to ask you to give some takeaways about what we've talked about today, the key things that would be important. If I'm a small to medium scale enterprise, small business, maybe I'm in that startup period, maybe I now see an opportunity where I want to develop the business and make it bigger. Mm-hmm. Maybe I'm a one-man band that thinks, actually, this is a great idea. And there are a lot of great ideas that have grown from somebody working in their garage. Absolutely. And, whatever the advice may well be, what people would go away, maybe the considerations they have to take. Remember, don't forget to say who you are at the very beginning. Take a sharp breath after I say go. Straight down camera. Number 1. I should close the lid of my laptop so you can't see it. So then, Andrew Weaver, my guest today, he's going to say who he is again in just a moment. But these are the key takeaways that you need to do from today's programme. Andrew. Hi, Andrew Weaver from LawyerFair, and I've had a great chat with Steve Hyland about raising seed capital. The important things to remember and take away are why you're raising it, what is the purpose for it, and make sure that you understand what the route map might be. Don't underestimate the time and the disruption to your own business. Try and operate your business on a very lean basis, because not only do you need to learn from the market and be able to develop from that, but it'll also show in the eyes of the investors how you think. And basically it's about a story. It's about not what you do, but why you do it.
And those are the key factors to take to an investor. And if you've got the right team, product, and there's an opportunity there, I'm sure you'll be able to raise the cash.
As simple and as straightforward as that. I hope you've enjoyed today's program. It's been absolutely fascinating. A bit more housekeeping before we walk out the door. Otherwise, I get my legs slapped, which actually is quite enjoyable. Don't forget, visit the news site and check out our Powerful Sales video workshop as well. You'll find that on Eventbrite if you want to book a place. We've got one coming up, I think, at the end of this month. If you're watching it on Catch Up, I think that was June 2015. If you're watching it in 2017, it's a bit like being on Dave, this, isn't it? Just whenever you're actually watching it, so do watch out for that. We've got the Business Networking Show on the 18th of September 2015. Keynote speakers are going to be Brad Burton, Stefan Thomas, Ruben Singh, and King of Shaves, Will King. He's going to be there as well, and we're going to be streaming live from the whole event for the single day that's on. It's at Wolverhampton Racecourse, and it's a cracking day out. If you thought today's program was great and you think, I'd really like one of those. I'm sick and tired of sending out newsletters that people don't read. I want to send out a 10-15 minute program that introduces my staff, the people that work for me, shows the products that I sell, is a little bit more, engaging. Then what you need is one of these. You need Your Brand TV from us here at Business Connections Live. Simply get in touch with us here at Business Connections Live and we'll tell you more about that. Back to me, please, because it's all about me. And also, what else have we got to tell you about as well? Don't forget, you can sponsor the program, too much to go on about. Next week's guest, that really does wrap it up. Next week's guest is Michael Graham from MJB Graham. Advice on business and sales development, how you can maybe double or triple your sales turnover. But that practically wraps up today's show. Thank you very much indeed for your company today, and my thanks to you, Andrew Weaver from LawyerFair.co.uk. If you do need to know the right legal people to talk to, go to the website, but really use this program today as your reference if you're thinking about maybe getting your business funded. A great place to start. Seed funding. Is it right for your business? If it is, after what you've heard from Andrew today, maybe you should start investigating that. From all the team here, can we just say thank you very much indeed for watching. We'll be back again live next Monday when we've got our next guest, Michael Graham, on the show. But till then, from all of us here, it's bye for now. Bye-bye.
Business Connections Live, the UK's leading online business channel.